From Wall Street to managing hundreds of millions in client money, Nick and I use our alphabet soup of credentials to discuss the investing and tax strategies that actually work. Oh, and we played Division I college football together, so strap in. This one hits hard. Let's go. All right, Life Goal Nation, uncertain times could be the understatement of the year, right? We don't know what's going on in Iran, how long we're going to be there, how much impact that'll have on the oil markets, how much impact that will have on our stock market. But I think the reality is, as you rewind the hands of time, uncertainty is not a surprise or a new thing. Uncertainty is the absolute norm. And so what we need to start thinking about is stop trying to predict where things are going to go and instead prepare for the inevitable uncertainty that is going to face you as an investor. So Nick, these are some hysterically funny statistics that we're going to share right now. Let me hand it over to you to kick things off.
Yeah, we're just setting the table here in terms of some stats around in investment performance and investors themselves, how they view themselves. 93% of investors describe themselves as above average financial decision makers, which is statistically impossible. At the same time, the average equity investor underperforms the S&P 500 by roughly 3.6% annually. And you can almost all of that can be attributed to behavioral mistakes driven by reacting to predictions that you got wrong or right. And then I think over the long term, the estimates are on a 100K investment in the S&P, the average return over 30 years, if you just bought and hold, was about 3.7 million. The average investor behavioral gap turns that into about 1.1. So huge missed opportunity for compounding if you're trying to jump into out of the market or making very concentrated, aggressive predictions on what's going to play out.
The funniest statistic of all of those to me is that 93% consider themselves above average investors. To your point, that is statistically impossible. And you know what I would find more interesting if we broke that down male to female as well? Because there is tons of statistical data out there that shows that women over the long term are far superior investors to men. And a lot of it comes down to the kind of psychological aspect of the difference between a man and a woman, that men tend to be overconfident and make decisions with more breakneck pace. And that tends to be a bad characteristic when it comes to investing. So you go from there, Nick, on to the fact that 3.6% underperformance. Now, what that references are folks that are investing in stocks. So it's not like, oh, this is someone that might have some stocks and might have some bonds, et cetera. No, this is folks that are invested in stocks underperforming the benchmark index of the S&P by 3.6% per year. I'll couple on another interesting statistic that I've seen from JP Morgan in the past to say that in 2022, the average investor in stocks was down 39%, which is an absolute bloodbath, down 39%. And it gets even worse when you have the realization that the S&P was down 19%. So clearly what folks are doing are jumping into and out of the market at all the wrong times. What is it they think they know? What is it they think they're getting ahead of? And I think that's where the prediction aspect of investing is so overstated in someone's ability to predict with any sort of certitude or any sort of consistency. And I think that we need to start to shift that landscape from prediction to preparation. So Nick, let's stick on prediction just for a minute before we get to the preparation stage. One of the funniest things is when the experts start to predict. Right? So it's not just the Joe Schmo investor, but it's also the folks that are analysts that are built to be the best in the business at forecasting what's coming in the market next. So every year at the beginning of the year, the S&P 500's group of analysts will put out forecasts to say what they think the market will do in that coming year. And as you look back at them, some of them become just as laughable as the statistics we just gave you. The experts are no better. Nick, hit them with these stats.
No, this is Wall Street consensus scorecard, right? So we're aggregating at the beginning of every year, Wall Street, all the different firms published their S&P 500 year-end targets. These are some of the most well-researched teams on the planet. They've got infinite resources almost, and they have billions in infrastructure to try to assess what's going on in the economy and where the market is heading in 12-month time. The track record is not great for them either. You look at 2020 consensus, the market was going to be flat to modestly up. In reality, we got a 34% crash in March. We were up 18% by year end. 2022, everybody was kind of cautiously optimistic. The S&P 500 was down 19%, worst year in 14 years, big miss. 2023, most people were mildly bearish, was kind of the median forecast. Post 2022, the S&P 500 was up 26%. So 3 for 3 here in the most recent years were directionally wrong. And these are some of the self-proclaimed best forecasters in the business. So it doesn't matter whether you're an individual or an institution, predicting the future is incredibly difficult to do.
So I'm going to give a pass to one of those. 2020 was a year that no one really could have seen coming, right? Literally, the governments around the world caused our economies to shut down, right? So you couldn't have foreseen the fact that we were going to have this virus outbreak, bang, COVID, everything shuts down, boom, the market is scared to death, gaps down very quickly, and then subsequently the market just gets puked stimulus into it via monetary stimulus, fiscal stimulus. You remember everyone was getting a PPP loan that owned a business. Everyone was getting a stimmy check, all of that. So that's what caused it to come surging back after that initial gap downwards in 2022. But as you look back on things and you go, okay, and well, that was 2020 rather, in COVID. You look back on things and you look at 2022, after the world started to digest all of this underlying stimulus that got pumped into the system, what caused that downside in 2022 that no one saw coming was all of that stimulation caused inflation to really rear its ugly head. And as inflation took off, stocks and bonds commensurately came down. And so that's also a very rough environment in 2022, where you not only have the stock market selling off 19%, right? The average investor sold off 39%, which is crazy. But also you had one of the worst years, literally the worst year since the Revolutionary War in the bond market. So there was no reprieve there. So at the end of the day, Nick, I think your comment is totally fair, just to say that, like, listen, you can't look at the experts and have them direct you how you should be invested. Because if you rewind back to the beginning of 2026, the experts were wildly, wildly optimistic, right? And it's still up for debate as to where we end the year, don't get me wrong. But I don't think anyone had on that bingo card of theirs that we were going to move into Iran and disrupt the oil markets, and you were going to see a massive sell-off in stocks in a 4-week period of time. And where does it go from now? Who the heck knows? But we're down 4 weeks in a row, and we've taken some pain here. And that was nothing that was on anyone's forecast coming into the year. So again, it just is behoove of every investor to stop trying to predict and stop trying to take outsized bets that the market's going to do great or the market's going to do terrible. It's going to be somewhere in between, and you have to be prepared for both underlying scenarios.
No, without a doubt. And I think there's a balance to strike too, right? Where you're taking that information in, but again, I think it's how you build out your portfolio around that, and making sure that you're not too concentrated on one or two predictions absolutely coming true in order to determine your financial success for the year or long term. So it's that information is good to bring in, to store, but you want to make sure that you're not putting all your eggs in a handful of baskets there.
Yeah, and it's not even just, okay, what are we predicting? Because a lot of times you can predict something playing out. As we got closer and closer to the Iranian invasion, we did see troops starting to move to that Gulf district, and the probability started to pick up, right? But then when we actually had that invasion, what would you anticipate something like gold to do? You would anticipate gold, if we're invading another country and oil prices are going to shock higher, being an inflationary driver, we're going to start spending a ton more money because we're building missiles and rockets and firing them. That's another inflationary impulse. So what is one of the best assets in history when you're in an inflationary environment? That's gold, right? And gold
Yep.
has recently just puked on itself. So not only do you need to be able to predict the future, but you also have to predict how assets are going to react as a result of that. And it doesn't always work out the way you want it to. And so that's, again, the prediction game is just a game that, hey, Taylor, Nick, we get calls all the time. Where's the market going? And it's like, what are we doing here? Like that's not at all what we do. We build portfolios, and we're going to get into some of that construction process here in a few minutes. But it's not a game of, oh, we know with some sort of certitude what's going to happen over the next month or so. Is it going to rally back? I don't know. We don't know how this Iran war is going to play out. And that's going to determine a lot of the underlying outcomes that we'll see over the coming months here. So, Nick, the other thing that comes along with these predictions is, hey, should we sell out of the market now? Is it going to go down further? Right? And so I think this is an important kind of concept to start to understand. If you decide you're going to jump out of the market, it's not just, okay, when are we getting out? It's a two-sided decision. It's not when are we getting out, it's when are we getting out, and then what is going to be that determining factor for us to get back into the market, which I think is even a harder decision than it is when to get out. So most of the time when folks are getting out, it's at that point of capitulation where their stomach just can't take it any longer and they say, all right, enough. And they puke out whatever it is. They sell their money. They get their money back out of the market at a 20, 30% reduction of where it was. And that's when the market finally hits that bottoming point and bounces. That's statistically when most people are selling. To state the obvious, that's how pricing works. But the other side is, then when are you comfortable enough to get back in? Even if you were to see things coming prior to any downside being experienced, the period of time that you get that level of comfort to hop back into the market is probably when it's far above whatever that decision was when you were trying to get out on the other end, regardless of whether your timing was perfect on the front end or not. So it's that two-sided decision that it is to sell out of the market that really is a tough equation.
Yeah, you're doubling the amount of variables there, and you're with your exit and entry point there. But it's just missing some of the best trading days, single days over the last 20 years. It's really been a costly mistake. And if you miss just 7 of the best 10 days over the last 20 years, you've left almost 50% of the returns on the table just in the S&P 500. And if you're looking at when those best days occur, 7 of those best 10 happen during a bear market. So again, it's very difficult. If you are going to jump out, the best time to jump back in is going to be extremely uncomfortable because you're still kind of on that downward trend. But again, over the long term, it's nearly impossible for folks to be jumping in and out with any level of consistency.
You're 100% correct. So, okay, we've gotten this prediction thing really well, fleshed out here, and the fact that no one can predictably predict what's going on in the market with any sort of consistency over time. So now we need to start to shift a little bit away from that prediction to preparation, right? Mm-hmm. This is not us making the case that you should only own stocks and close your eyes and hold on to them forever. That is not the case we're making here. The case is, instead of trying to predict, it's the preparation. And it's the preparation of what's in the economic pipeline that we need to start to think about. Because the biggest thing that determines when downsides of the market, persistent, sustained downsides in the market take place is when we go through some sort of economic indigestion, right? Our economy starts to falter some. That is when you get the pickup in downside movement in things like stocks, right? So let's just take a second and assess the different areas of the economic cycle that someone needs to be prepared for.
Yeah, so there's the kind of the classic 2x2 macro regime that folks are looking for. So if you're thinking about this as 4 boxes, on the x-axis will be inflation. Inflation's lower, inflation's higher, and then on the y-axis you'll have growth, weak growth, strong growth, right? So if you have strong growth and low inflation, that's typically called the Goldilocks environment. This is a really good situation for the underlying economy, and typically tends to be a very good environment for both stocks and bonds and a variety of other asset classes. When you have high growth but inflation is high, that is typically categorized as an overheating economic regime. And then the areas that you really want to avoid are a deflationary environment, which is weak growth, but you also have falling inflation. And the one that I think everybody's a little nervous about right now is a stagflationary environment where you have weak growth but high inflation. This is a very difficult economic and an investing quadrant to be in. So those are kind of the four major economic regimes that folks are classifying things into. So those are the different stages of economic regime change and regime change. I'm thinking of the Iran war here of economic regime classification. And I think when you're building out your portfolio and looking at those, it's important to recognize that different asset classes are going to perform differently in different parts of the cycle. So Taylor, how do we think about that part of the process in our portfolio construction there?
Yeah, so let's kind of broadly define as growth, inflation, stagflation, recession, right? Those are kind of the four main areas of the economic cycle. And the reality is no one can predict exactly where we are at any given juncture or where we're going next. So I think to your point, you need to have the understanding that I have pieces of my portfolio that are going to work throughout each part of that economic cycle, right? Ray Dalio calls it an all-weather tire, right? Or all-weather portfolio, but all-weather tire is how I like to correspond to folks with because, again, rain, sleet, snow, hail, heat, and everything in between. So when you think about it, most people are really, really, really well prepared for the growth stage of the economy, right? And that's stocks. Stocks in that Goldilocks, when it's high growth, low inflation, the stock market is going to be your best friend. And, you know, take it one step further, probably add a little Bitcoin and a little crypto on there, and you can really rock it. When inflation picks up, when inflation's modest, stocks are still going to do fine. When inflation starts to pick up more meaningfully, that's when stocks start to struggle. And we saw that play out in a 2022 environment, right? So we'll get to inflation in a second. But from a stagflationary, that's when you're starting to see growth start to slow and inflation staying persistently high. That's an environment where some bonds may perform well because what you're getting there is inflation is not necessarily a productive thing for bonds. Inflation usually beats bonds up. But when you have the counterbalance but you also have the economy weakening, that's a positive for bonds. So when you slice and dice the bond market, there are areas of the bond market that are going to perform well during a stagflationary environment. And that's typically what you're looking for when you start to have that kind of inflationary pressures remaining relatively high and you have the weakening growth. Bonds are typically going to do well in that environment. When you go to a recessionary environment, that is where bonds absolutely excel. Everyone looks for a flight to quality. They say, hey, I don't trust the stock market. What do I trust? I trust the U.S. Treasury market, right? And so that's when you're going to see typically a significant movement higher in bonds. And so what are stocks going to do, on the other hand, in that recessionary environment? Obviously, they're going to get beaten up. And so you look back to a 2008 type scenario, the S&P draws down 55% peak to trough. Now, if you look at the broad bond index in a 2008 environment, it's up a little over 5%. But if you look at the extreme case of long-term treasuries, they were up 34% in 2008, right? So I think a lot of people look at their portfolios and it's some blend of either all stocks or stocks and bonds, a 60-40, right? And so what you're relatively well suited for there is growth. In a growth-based economy, your stocks are going to hold up well. In a recessionary-based economy, your bonds are going to hold up well as your stocks get beaten up, and there's kind of your counterbalance. But I think what people are grossly underprepared for is that inflationary environment. And whether that's coming with high growth and the inflation coupled with it, or low growth and the inflation coupled with it. Inflation is really a pervasive problem for most people's portfolio construction. And what we look at a lot of times when it comes to inflationary environments and how do you protect against that, that's that alternative suite of products that we pound the table on all the time. So what the heck is an alternative? It's a lot of different things, but you can have everything from real estate to infrastructure. Both of those should hold up really, really well in an inflationary environment. And you ask why? Well, with real estate or infrastructure, You got concrete in the ground, steel in the ground. You've got a hard asset that you're backed by there, right? So that's something that's really productive there. Now, typically during an inflationary period, you're also going to have hard asset commodities doing well. Inflation is often caused by a movement higher in oil prices. So clearly, that hard asset of oil is going to do well. Gold typically holds up well during a period of inflationary kind of pervasive nature. Farmland, something that we own for most clients of ours, and most people don't even know that's an investable asset, but farmland is something where, again, a hard tangible asset during a period of inflation is typically going to hold up relatively well. And so at the end of the day, when you kind of take a step back, you say, hey, I need to know in my portfolio what each position is going to do regardless, or more importantly, what each position is going to do during each period of the economic cycle. And you need to have a very ingrained knowledge of that, because you don't need to have a situation play out where everything's selling off at once. If you're an equities only investor, you're in a growth stage, you're great. You're in any other environment, you're typically really struggling. And thankfully for you, for the past 10 years, it's been, a persistent growth-based economy, but it won't always last that way. So Nick, feel free to kind of round out any edges there, but I think it's important to understand that you have the different pieces to prepare, not predict. To be clear, this is a preparation, not a prediction of where the economic cycle is taking us.
Yeah, I mean, it's really a form of risk management, right? And you just want to make sure that you're not overexposed to any one part of that economic cycle. And it's been really easy to drift into a portfolio that is really designed for that high growth, low inflation, Goldilocks type of environment, because that's what we've experienced. And if you look back historically, I think it's about 68% of the time here in the U.S., going back over the last 50 years, we've been in kind of that quadrant. So it's been easy for investors, generally speaking, to drift into asset classes, stay overweight those typical stocks and bonds that have done well in that environment, and kind of neglect some of these other asset classes that are really going to hold up and better diversify, prepare your portfolio for an evolution and a rotation into one of these other quadrants, whatever it may be. So it's something that I think investors really need to think about, because it's been easy to skate by, get away with having a portfolio construction that just does really, really well in one of those economic regimes.
Yeah. The only time that people have experienced that significant downward movement on a stock and bond portfolio recently is 2022. And 2022 was literally one of the worst years of all time for a 60-40 blend of stocks and bonds. The worst year since I think it was 1937, right? So in 2022, we already touched on this a little bit. What you had was a massive pickup in inflation because of the economic stimulus that was pumped into the system post-COVID, and also an invasion of the Ukraine by Russia. And so that snarled the supply chains, a lot of the things that we're seeing play out with Iran right now, but at a bigger scale. And so that caused that persistent inflation to pick up, and that stock and bond portfolio, when inflation went to 9%, which was the highest inflationary rate we had seen since 1981, I believe, that really caused stress on that stock and bond portfolio. And it made people realize, hey, maybe there's another asset class that we need to out here, that is out here that we need to be considering. And it's funny because although the retail or mom and pop that goes through a financial advisor type client hasn't realized the use of the alternative or private markets as much, when you look at the institutions, the smart money, if you will, the institutions have been utilizing the alternative space in a massive way for decades and decades. Whether you look at Harvard Endowment, Yale Endowment, University of Texas, like those are the three biggest endowments in the world. They have been huge proponents of the use of alternative assets. And Barron's, interestingly, just ran a survey in the past year, and it spoke to family offices. So this isn't institutions. These are family offices, over $50 million in assets. Family offices currently own 41% alternatives in their overall asset allocation. And for context, the next largest percentage of their portfolio was in equities. So 41% alternatives, the next were in stocks, and that was just 29%. So I think that's eye-opening for folks to say, okay, this really smart high-end money is really preparing for things differently than trying to predict what's to come next. And therefore just, looking at the rear view mirror and saying, well, stocks have worked in the past. I'm just going to stick with that kind of working horse that got me here. And reality is it's just, that's not the probabilistic way to invest. And that's what investing is all about, is putting yourself with the highest probability of successfully attaining whatever the goals that you have are.
So I think in another important aspect when we're talking about portfolio preparedness and what that allows you to do is it can make volatility an ally and not necessarily your enemy, which may not sound like a ton of sense right now, especially if you're looking at your account values and they're moving all over the place and it doesn't necessarily feel good. But I think for a long-term investor that has discipline, this provides buying opportunities. You can rebalance, and it forces you to buy things that are down, sell things that are up, in a systemized, contrarian kind of way. That over the long term, I think really benefits investors.
Yeah. Talking about volatility as a good thing is not necessarily something that someone wants to hear when the volatility is all to the downside right now. Yeah. But and that's all asset classes, right? Because in times of stress in the market, what you have is correlations come to one. So typically, if you look at the market landscape, it's not stocks, bonds, gold, everything moving in lockstep together. Now, the only thing that's kind of bucking that trend right now is oil, which is moving counter, right? Which is causing a lot of the distress in the market right now. But right now, it seems to be that everything is kind of directionally moving downward, right? And now the alternatives that we talked about before is also another asset class that is not moving downward. Depending on what it is you own the alternative space, they're holding up really well right now. But Nick, I think your point is really well put, because I think there's a couple different ways to think about rebalancing, right? If you're a typical kind of retail-oriented investor that's not doing things in an overly sophisticated way, I think the rebalancing on a set schedule is very smart, right? Especially if it's not in a taxable account. If it's in an IRA / 401k, whatever, where you don't have to worry about the tax implications of a movement, I think that timing things out on a rebalance monthly, and monthly is probably too much, rebalance on a quarterly basis, et cetera, is a really good kind of thing to aspire to do, as that will allow you to, okay, stocks really got smacked badly right now and bonds held up better. Well, I'm going to rebalance back, and that's going to have me adding more stock exposure on periods of weakness. It just helps really create a solid level of discipline. Now, you start to take it to the next level and do things in kind of a more of an institutional manner or sophisticated way of trading, and then it's not on a set time frame. Because, reality is making a decision because it's March 31st really doesn't make a ton of sense either. But it creates discipline, right? That's why I say if you're not someone that's in this and paying attention to it every day, that's a really good methodology. But what you want to do is you want to put risk bands in place. And you want to use market volatility to dictate when the portfolio is being rebalanced, not a time or a date of the year. So what happens is you have those risk bands in place. Hey, I want XYZ exposure to things that are in this underlying category, growth-oriented assets, inflation-oriented assets, whatever it is. And so as asset prices move and they go up or down, those risk bands may be tripped. And once those risk bands are tripped, that's when the portfolio needs to be rebalanced. And that's how you do it from a more institutional standpoint. Hey, in a 2008 environment, you have growth assets coming crashing down and stocks are falling precipitously. But we already talked about on the other side, bonds are doing incredibly well in that 2008 environment. What you want to be doing is you want to be trimming from bonds during that period of strength to add to stocks on that weakness in 2008 as they're getting absolutely pummeled, right? It's not a comfortable thing to do. Yeah, let me sell my winner to buy a loser, right? But at the end of the day, we all know what happens to stocks in a period of a recession. They go down like a coiled spring, down, 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 and then bang, they erupt higher. So what you're trying to do is very systematically move from that asset that's gone up in value to add to that weakness in stocks, because you're never going to catch the bottom perfectly. The only person that catches the bottom is a liar. Right? So the reality is what you're trying to do is build around that bottoming process and increase your exposure during that period of weakness. But to be obvious here, to state the obvious, you need another asset class that is doing well when stocks are getting beaten up in order to be able to add to stocks on that weakness. So you really need to understand when the different assets you hold are going to do well and poorly during the economic cycle. And you need to start to combine those players on the team, if you will, in order to protect each other's weaknesses and allow you to take advantage of dislocation in the market.
Yeah, without a doubt. And if you look over the long term, right, the S&P averaged about 10.6% annually. If you were buying when equity inflows are the highest, right? So and generally speaking, the market will have been moving higher, maybe getting to a peak. Typically, your annualized 3-year returns from that point is about 5% when equity inflows are the highest. When equity outflows are the highest, conversely, and you're putting money to work in the S&P 500, your annualized returns for the next 3 years tend to be 13.6% or north of the historical average of the S&P 500. And that's, sounds like common sense for investors, be greedy when others are fearful and fearful when others are greedy. But it's very difficult to do in practice, especially if you're not diversified properly. You don't have enough buckets to pull from to go add to stocks in that environment, and you've already seen your stocks get absolutely ripped and everyone else is heading for the door. Psychologically, that's a very difficult environment to be in. And again, having a portfolio that's prepared for those type of environments, I think helps you better step into that weakness when everyone else is heading for the door and make the right investment decision for the long term.
So, Nick, basically my takeaway for this entire podcast is don't pay attention to anything except for equity flows. And when they're out, start pummeling money back into it. Now, I obviously that's oversimplified, but at the end of the day, like that's what you want to be doing. You want to be buying at times that are scary, right? You want to buy when there's blood in the streets, right alongside Warren Buffett, right? He's buying when the equity assets are seeing massive outflows. But it's so counterintuitive because FOMO is so real in the investing game. It's everything in our life is fear and greed, right? That's what basically, caused our evolution along the way, was being able to, take advantage of things when times are good and then run fast when there was a Loch Ness monster chasing us in the other direction. But that's the reality of how people think about investing too, is FOMO is very, very real. If you see everyone getting rich and you hear everyone, hey, I just bought 3 Bitcoins, 2 years ago and they're at 24,000, now they're 125,000. Like it's really hard to stay out of the way of that vein of chasing. And, but that's exactly the opposite of what you're supposed to do. So that's interesting context, Nick. I'd never heard that statistic around inflows versus outflows and how counterproductive it is when everyone's putting money to work to be putting money to work. That's when you should be taking it out. You should be adding it as people sell out of their assets.
Yeah, and I think in addition to that, right, we're when you're not necessarily timing those moves, but when you are making those rebalancing decisions, again, volatility can be your friend if you're positioned right. And I think the other part of portfolio construction and investing in general is the fact that you're not going to be right 100% of the time. And so you want to make sure that you're sizing your positions properly. And I think that's something that, we're going through in building a portfolio. That's something that we're very focused on and want to make sure that we're, again, building out positions that are going to be able to provide performance in each of those different economic cycles. And I think that's one of the other benefits of our process and using things like alternatives, right? So,
yeah. It's funny that you say that because one of the biggest things when I just talk to like friends that just, hey, Taylor, I thought about buying this and that. And I oftentimes ask them, they may tell me about this great trade that they had. And I say to them, okay, well, what percentage of your money was in that trade? And they're like, 5%, 10%. And they made a 100% return or something like that. And I'm like, well, that's great. And that's 5 to 10% of your assets. Like, where's the other 95%? And they're like, well, obviously I wasn't going to put it all in that basket and I'm sitting on cash with the rest of it. And it's like, that's the opposite. What you're doing is you're taking a very high risk flyer on one And I know that they've gotten some wrong, but they only tell me about the ones they've gotten right. So I'm hearing about the good ones, and they have a 5 to 10% exposure, and then they're sitting on cash with the rest of it. That's just a completely unproductive asset, right? Especially during a period of inflationary kind of times, you just have that degradation of that cash every single day as the purchasing power starts to go away. So instead, what it is, and what we talk to our clients about is, hey, we want as much of your capital invested at all times as you don't need for an emergency, right? So like, yes, we're not saying don't have an emergency fund on the side, or if you have a purchase that's coming in the near future, let's not, invest that money, et cetera. But otherwise, all of your assets need to be invested in productive risk assets. Risk assets, to be clear, you want to be taking risk with all of those assets, but you want those risks, as we keep talking about, to be complementary to each other. So not everything is doing well at the same time or everything doing poorly at the same time. But every risk asset is going to outperform cash over time. There will be periods of time where cash outperforms other risk assets, but there's no risk in cash. So the reward comes along with risk, and what you need to do is align that risk and get all of your assets to work in a complementary fashion. So you're getting a return, a productive return on all of your assets rather than sitting on 90% in cash or something like that.
Yeah, 100%. And I think, kind of as we go through that portfolio construction process, another aspect that people want to keep an eye on is the costs, right? And we want to be efficient in the way that we're building a budget for the investments that we're going to be putting our money into. There's efficient parts of the market, there's inefficient parts of the market, and so it's important, I think, for investors, and something we think a lot about is kind of how to spend that budget in accessing these different markets across equity, fixed income, and the alternative space.
Yeah, no doubt about it. To your point, the efficient areas of the market is where you want to strip out almost all cost, right? If you're buying U.S. equities, there's probably a way to do it almost darn near for free, right? In an efficient area of the market. When you're buying global equities, maybe I don't want to own every Chinese stock. Like, call me crazy for that, right? But if I'm buying a global index, I am going to own every Chinese stock, right? And maybe that's an area where I start to shy away from just the absolute lowest cost approach. You want to be cost conscious with everything. You want to use the least expensive tool for the job, but that tool needs to be the best tool for the job too. So it's really well put point, and it's something that we think a lot about. The alternative space is one that is inevitably more expensive, right? And it's not to say that you shouldn't use it because it's expensive. We obviously are big believers in that. It's always not, okay, what is the expense ratio of that underlying product? It's what's the risk-adjusted return it's provided for that expense ratio, right? That's really, and a lot of times it's as simple as just asking, you look at something like private equity and it's, okay, the expense is X. What's the return after the expense? Net of that fee. Mm-hmm. Is it better than what you can get elsewhere? Yeah. Okay. Well, do we want that expense to be as low as we can? Absolutely. But we're not going to get any lower than that because there's nowhere to buy it that cheap in the market. You can't buy it at Vanguard ETF rates in the private equity space, but the performance has been better net of that fee. So that's really the important driving factor there.
Well, and there's been a couple folks that have rolled out private equity ETFs. So they're claiming low cost investments into shares of private equity. Those things have gotten absolutely rolled performance wise. You're getting what you pay for. Again, it's the wrong vehicle for the wrong asset class. So you got to be careful if you're always going for the low cost provider. There can be a lot of risk in there, especially once you start delving into some of these more inefficient parts of the market.
Yeah, well, and at the end of the day, like, I understand why retail focuses as much as they do on that cost, because at the end of the day, if you can't discern really differentiating factors between one investment and the other, there's one very easy thing to point at. This one's higher cost than this one, so I'm going to buy the lower cost one. But again, that comes with maybe just a lack of knowledge around a lot of the other aspects of an investment that you should be considering when you're thinking about building it. So anyway, well, listen, Nick, I think as we kind of wrap things up here, at the end of the day, the big takeaway from this overall conversation is like, listen, we're in uncertain times right now. There's no doubt about it. But I think that when you look at history, it's more often we're in uncertain times than we are in certain times. And trying to play the game of prediction is one that is not successful over the long term. And that is the game that most investors have tried to play, which is why returns have been as shoddy as they have been relative to just the broad markets. So at the end of the day, it's not about prediction, it's about preparation. You know uncertain times are going to present themselves, and the portfolio needs to be able to prepare and navigate through all of the geopolitical nonsense and all of the economic cycle that we will inevitably continue to experience going forward. So appreciate the heck out of you guys today. We'll be back next week on Wednesday. Thanks so much. Talk soon. Quick ask. If you're enjoying the show, hit the follow and drop a rating. It helps more folks find our podcast. Thanks so much.
The information discussed in this video is for educational purposes only and should not be considered investment, tax, or financial advice. Investing involves risk, including possible loss of principal. Always consult a qualified financial professional before making any investment decisions. Past performance is not indicative of future results.